Hello, everybody. This is AK. I'm back. So, recently, someone asked me what I thought of Capo Corporation, right? Whether I had an opinion on Capo Corporation. Well, I'm not invested in Capo Corporation, and the last time I looked at it was when it was dumping its oil rig business on Sembawang Marine, right? SMM. Of course, now SMM is called Citrium. I don't like that name, Citrium. It reminds me of a multivitamin brand. I think it's Centrum. Citrium doesn't sound like a company that's involved in manufacturing of oil rigs and stuff like that. Anyway, so my reply was, well, since they got rid of their marine arm, offshore and marine assets, they are doing much better, right? They dump it on Sembawang Marine. And I blog about that as well, why Sam Marine shareholders got the shorter end of the stick. Anyway, Capo Corporation apparently released a voluntary business update recently. So apparently they have a year-on-year increase in net profit, right? And but that is only if they exclude the effects of its legacy offshore and marine assets, right? If they've included that, then not so rosy, right? So the net profit was apparently bolstered by stronger performance in the infrastructure segment, including the effects of the legacy offshore and marine assets. Net profit would have been lower year on year. Right, so this shows how Capo Corporation is now focusing on asset-light, capital-efficient growth. Right, so it reminds me a little bit of what CapitaLand was doing in the past. When the CEO who said shoebox apartments were inhuman was running it. He went asset-light, and then he spun off assets into REITs and all that kind of thing. Right, so it's supposed to be more capital-efficient. And their recurring income rose 51% year on year. Capo Corporation's recurring income rose 51% year on year, with stronger contributions from both asset management and operating income. So, as an investor for income, that sounds quite attractive, right? So they got rid of deadweight in the corporation, in the conglomerate, and they decided to focus on the income generating segments of the group, and apparently is bearing fruits, right? And they continue to monetize their assets, so they have already monetized about $170 million of assets this year. And that include the proposed divestment of a residential project in Wuxi, China. I don't know whether I pronounced that correctly. Wuxi, China. So I don't know how much that is going to help, especially with the residential market in China having crashed. Maybe they could recover their costs, I don't know, right? So they have apparently monetized assets to the tune of 5.5 billion Singapore dollars since October 2020. So they are really serious about going asset light, right? And monetizing as much assets as possible, right? And well, now as an investor, what should we look at, right? Say you look at the balance sheet, right? Apparently the gearing is at 0.9 times. 0.9 times gearing, there's like 90% gearing, right? Which sounds high, but it is much lower when you compare it to ST Engineering, which is I think 2 point something or 3 point something times. I can't remember exactly now. I made a video about that, so I'll leave a link to the video in the description box below about ST Engineering if you should be interested. And Capo Corporation currently trades at almost 13 times PE, which seems okay, seems fairly valued. 1.2 times price to book seems fair as well. 5% dividend yield seems decent, right? But it is on the back of 0.9 times gearing, or 90%, I think. Analysts are saying buy, and some have a target price of higher than $8 per share. What do I think? Well, 12.7 times PE, 1.2 times price to book, 5% dividend yield. I think it's fairly valued. It's not a screaming buy, all right? Especially if you compare it to the banks. I mean, it's not apple to apple comparison, but when we invest, we must always think of what are the alternatives. And I feel more comfortable investing in the banks. I mean, definitely we could think of getting a foot in the door where Capo Corporation is concerned, but I think that might be a better entry point at some point in the future, right? So I'll bear that in mind. It's now at almost 13 times forward PE, 1.2 times book, and 5% dividend yield. Maybe if it should come down below book value, below 1 times price to book, maybe that's the time I'll look at it again. Okay, so if AK can talk to himself, so can you. Bye bye.